In 2022, we watched $40 billion evaporate in days when Luna collapsed. And if you were watching Coinsider back then you knew it was coming, as we were one of the first to call out the critical flaws in Luna's design. But now, there's a new protocol offering 25% yield on a stablecoin that's being called the next Luna. So of course I had to dive in and read every bit of info that I could find about it. And today, I want to share with you everything that I discovered. We'll discuss whether or not it could collapse like Luna, whether it could rocket like Luna, and then finally, my best prediction on what's actually gonna happen. Okay, but before we get into all that, we gotta rewind a bit. You see, back in 2022, Terra Luna was the darling of the crypto world. Its CEO Do Kwon was everywhere, and everyone loved him because of his charisma. But anyhow, Luna, at its core, was trying to create a decentralized stablecoin called UST, which would maintain its peg to $1 through an algorithmic relationship with its token called Luna. Now, this system seemed innovative and elegant. Like, you could always trade $1 worth of Luna for 1 UST and vice versa. So when UST demand was high, you'd burn Luna to mint UST, thus reducing Luna's supply and driving up its price. And when UST demand was low, you'd do the opposite, burn UST to mint Luna. But yeah, people shoved billions of dollars into Terra and its savings protocol Anchor, which offered a staggering 20% on UST deposits. This made Terra a top 10 project at the time, and that's why most people assumed that it was too big to fail. However, its system had a fatal flaw, one that would end up triggering a death spiral. And here at Coinsider, we were the first YouTube channel to break it all down for you. You see, the whole system relied on one critical assumption, that the Luna token would always have the value needed to maintain the UST peg. But you see, its value was entirely speculative. So when that assumption was put into doubt, all hell broke loose. The system entered into a death spiral as UST lost its peg, and then more Luna was minted to try to restore it, and then this just crashed Luna's price even further, which required more Luna to be minted, and on and on. So yeah, at the time there was a lot of debate as to what would actually happen, but in hindsight, it all just looked inevitable. But anyhow, now that we got a good refresher as to what happened to Luna, we could now turn our attention to the next hot DeFi project that people are comparing to Luna, and that's none other than Ethena. Okay, so at its core, Ethena is trying to create what they're calling an internet bond, aka a dollar peg stablecoin called USDE that generates yield from crypto market activity. Ethena is currently ranked around number 50 on CoinMarketCap with a 7 billion fully diluted market cap. And USDE has become the third largest stablecoin at over $6 billion in market cap. So it's fair to say that it's already captured significant value and is growing almost as fast as Luna did. But with yields of over 20% on a stablecoin, people are asking the obvious question: is this too good to be true? Well, here's the thing. At first glance, Ethena and Luna seem similar. After all, they're both trying to create stable assets with high yields. But if we look closer, this is where the similarities end. You see, Luna was kind of like a perpetual motion machine. It tried to create value out of thin air, while Ethena, on the other hand, is more like a sophisticated arbitrage system. Now, that may sound complicated to you, but here's how it works on a high level. So they hold coins like BTC and ETH, right? And then they simultaneously short the same amount on exchanges. So when crypto goes up, they profit on their holdings while they lose money on their shorts. But when it goes down, they lose on their holdings while profit on their shorts. So the result is that their portfolio stays stable regardless of market movements. And that all sounds quite simple, right? But here's where it gets interesting. You see, they're not just simply holding their coins, they're actually earning yield on them from two very different sources. First is staking rewards from their ETH positions, and then second is funding rates from their short positions during bull markets. So that's why we gotta be nuanced about these high yields. Like, sure, both Ethena and Luna offered 20% yields or more. But the difference is that Luna's yields were essentially manufactured through the Anchor protocol. It was a fugazi.
Fugazi, it's a wazi, it's a woozy, it's a fairy dust.
While Ethena's yields come from actual market activity. When traders go long in bull markets, they pay funding rates to shorts to keep their positions open. And Ethena captures these rates systematically, turning this market behavior into sustainable yield. So no, this is not Luna 2.0. They've essentially captured the essence of what made Luna attractive in the first place, but with a totally different system and approach. But here's the thing, just because Ethena is built on the same shaky foundation as Luna doesn't mean that it's risk-free. You see, we did our usual thorough analysis on Ethena, and we found a few places where things could go wrong. First, there's funding rate risk. Like if markets turn bearish, then funding rates could go negative, and this would reduce or eliminate those juicy yields. Second, there's custodial risk, as their assets are held by third-party providers. And while they do use bankruptcy remote trusts, there's still some risk with any centralized component involved. Third, there's market liquidity risk. Like, their strategy depends on functional derivatives markets, right? But major market disruptions could impact the stability of those. Like exchange failures, for example, those could cause potential issues for their system. So those are all legit risks that we have to be mindful of. But here's the thing, Ethena's team knows about those risks and have put in place certain plans to protect against them. Like they've established a $46 million insurance fund that grows with the protocol. They use off-exchange settlement providers to hold assets, and unlike FTX or Celsius, their assets are held in bankruptcy remote trusts, which means even if a custodian fails, their user funds remain protected. Furthermore, they've diversified across multiple different exchanges and assets to mitigate the liquidity risk in their delta neutral strategy. Finally, they've set up a professional risk management committee to oversee the whole thing. But yeah, by now it must be clear that Ethena is fundamentally different from Luna. But just because it won't collapse like Luna doesn't mean it can't rocket like Luna, right? After all, unlike Luna, which pumped on hype and Ponzi-nomics, Ethena is positioning itself as something that traditional finance actually desires. You see, they're not building yet another stablecoin. They're creating an internet bond. And this is super smart because TradFi is hungry for these stable, high-yield dollar alternatives. That's why we're already seeing major players take notice, like Fidelity's backing Ethena, Brevin Howard is too, and they're already listed on multiple tier 1 exchanges. So we got institutional interest, check. A simple yet elegant design, check. So it's gotta rocket when the bull market returns, right? Well, there is a catch, and it's a big one. As Ethena's success depends on specific market conditions, funding rates have to stay generally positive, the crypto market needs to maintain liquidity, institutional appetite needs to keep growing, and then there's regulation. You see, while most stablecoin projects fear regulatory scrutiny, Ethena might actually benefit from it. Their institutional approach, professional risk management, and transparent backing could make them one of the few protocols that survive a regulatory crackdown. But on the other hand, this same institutional focus means that Ethena probably won't see the same kind of rocket ship growth that Luna did. Plus, I wonder if Ethena is as memeable as Luna was, because these days, that's a huge driver of growth in the crypto world. Honestly, I don't think that it is. But hey, that's probably a good thing at the end of the day. So, back to our original question. Is Ethena the next Luna? No, of course it's not. As we've already seen, it's not built on the same flimsy foundation as Luna was. We got real assets instead of algorithmic promises. We got market-driven yields and professional risk management instead of tweets saying, "Steady, lads." But despite its collapse, Luna did demonstrate that the market was hungry for a simple, yield-driven financial primitive that everyone could participate in. And Ethena is tackling that problem head on. So hey, you never know, it might just catch on. Overall, I am bullish on Ethena, and I even own a little bit of its Ethena token. But you know what other project I'm bullish on? Well, that's none other than Hyperliquid and its Hype token, which has held up extremely well during this recent market correction. If you want a deep dive into its pros and cons, then just watch this video right here.